Robin Marshall. He's Director of Fixed Income at Smith Williamson Investment Management. Thanks very much for coming in, Robin. And I suppose just listening to those comments there from Trichet, perhaps nothing new, nothing that we haven't necessarily heard before. But nevertheless, what do you read into what he was saying? A systemic risk. Are we moving into a new phase in the crisis?
Yes, first of all, they recognise they're out of the denial phase at least, and they recognise there is a serious problem and it's gone way beyond Greece. So the mention of systemic risk is new from Trichet, certainly, and I think he's putting pressure on politicians before this October 23rd deadline to come up with something that is, in a sense, a systemic solution. I doubt they'll be able to deliver within that deadline, personally.
What would a systemic solution involve?
Well, clearly, a big bank recapitalisation and big haircuts for the sovereigns. Those are two fundamental requirements of this. There's a huge shortage of capital in the banking system, and indeed that's now extended to the sovereigns that bailed out, of course, the banks in 08-09. So that's what they've got to fix. Just denying there was a problem only made the crisis more severe, and of course and they've now set themselves, I think, an unrealistic deadline personally, but leveraging up the EFSF won't fix it either. But
why not?
Well, you remember that's simply a CDO, that's, if you like, a group of distressed sovereigns underpinning it who are trying to rescue distressed sovereigns.
But I suppose you could, it's a way of sort of expanding the EFSF perhaps without having to go through any sort of ratification through European parliaments or actually physically putting money into it.
Yes, you might argue it's better than nothing, but the task before them is so colossal in terms of the scale now of the debt burden that they're seeking to relieve that I find it very hard to see how the EFSF on its own will do it. There's going to have to be a lot of burden sharing around the system, much bigger haircuts in Greece.
Who will bear the brunt of that burden sharing?
Well, that's going to go out to bondholders as well as governments or taxpayers. So, of course, plugging the capital shortfall is the key to all of this. Raising equity capital for the banking system, and it's going to take time. It isn't quick. It's going to take years, not months or a couple of weeks to come up with some magic solution.
So tell me, what do you expect in a week's time?
Well, I think very little personally. There will be the outline maybe of an upgraded EFSF,
right?
Which might be better than nothing. But
upgraded, what do you mean?
Well, to the extent that they will maybe put in place some sort of outline of how they would leverage it up so that it could take some... So
there will be traction on that issue?
Yeah, there will be some traction, and there will take some, so that the EFSF will take the first equity tranche, if you like, of the losses. But that isn't going to be enough, I don't think, to attract a lot of sovereign wealth funds in Asia to come and invest in the Eurozone. But
that would be a big deal in itself, wouldn't it? That discussion on leveraging the EFSF, given that Germany is not in favour of it?
No, it's some sort of progress, but of course there's an underlying disagreement that's still in place between Germany and France here, which, if anything, may be deepening between whether the EFSF takes this on and whether the national governments take this on.
How is that going to be resolved, or how difficult is it going to be to come to some sort of agreement on that?
Well, I personally think they're never going to get fully to grips with this. I don't think there'll be a fiscal union, and I think in the end the thing is going to pull apart, and the weaker countries who are not competitive, because remember there's one enormous elephant in the room here which people don't like to talk about, which is the complete lack of competitiveness of some of the members in southern Europe, and in the end they will have to leave, led by Greece. So it's all very well, you may be able to fix the debt stuff. I think that's a big ask. But if you can't fix the competitiveness, there's a limit to how much austerity and debt deflation you can go on doing in these countries before a peasants' revolt or rebellion, whatever you want to call it, and they leave. And that, to me, is the likely outturn.
When would that potentially happen?
Well, that's a longer project. You've got to find a way of getting them, of them leaving without the financial system completely imploding.
But that's the thing. If Greece were to leave, the consequences would potentially be far more catastrophic than if they... there is a scenario where they can default and stay very much within the Eurozone.
Well, yes, the first thing, they can default and stay in, but they have to see some future, some economic recovery, not a permanent period of permanent austerity, which is effectively what the Troika is telling them. If you're successful, you're going to wind up with debt to GDP of probably 140 5% of GDP in 3 years' time. Now, you can see the way the public is now responding to this. I mean, they don't want to accept the austerity that's being imposed upon them indefinitely. There's no future in that for them.
Two of Europe's most indebted countries have just gone to the bond markets. Demand for Italian bonds rose, borrowing costs fell, but those costs climbed for Greece, which managed to sell more than €1 billion of debt. I want to get some immediate reaction to all of this from Robin Marshall. He is Director of Fixed Income at Smith Williamson Investment Management. So what do you read into the results of these bond auctions? They seem to have gone through, but of course we keep getting these reports about ECB participation in the market. Do you expect this to continue in the short to medium term future?
Well, yeah, I think that the auctions don't tell us a lot, because we know the ECB, if needs be, would be in the background to underwrite them, and you never get full detail on them. So I think they'll ensure that the auctions don't fail. The bigger issue is the refinancing of these countries, clearly in the medium term, longer term, and the scale of the defaults for Greece, etc.
Okay, so those are the big issues that they need to confront. We were speaking a little bit earlier about the two big challenges facing European leaders, and they've delayed their summit by 1 week to try and come up with a more comprehensive solution, if you like. And the two big things right now seem to be recapitalization of the banks and shoring up the peripheries. So you tell me, which one should come first?
Well, you could argue you probably need to do both in the fullness of time. I mean, the issue, when you look at these banking crises, in the end, normally you've got to raise capital and isolate the toxic assets. And to me, so that the banking system, one way or another, has to raise equity capital. Now, that may be through national governments taking stakes again. Of course, there are differences in opinion between France and Germany on that, or whether the EFSF gets involved. But there's also the issue, clearly, of the related issue of the sovereign debt refinancings. And in some ways, it's probably cheaper to do sovereign debt refinancings using the EFSF. But I think there'll have to be both, and there's clearly a huge capital shortfall. These two, the whole system is so closely interconnected, it is now deeply unstable, which is why, between the banks and the sovereign debt.
Given the political divisions that we have and the obstacles that Eurozone policymakers are up against, which is the most realistic? What could they actually achieve?
Well, I think the difficulty is agreeing a multilateral solution, if you like, involving Germany, because that in turn involves a commitment to political union, which Germany has not been prepared to make.
Would Germany go for this ECB Vice President Victor Constancio's proposal that essentially the EFSF should underwrite or guarantee sovereign bonds?
Well, so far no, because Germany's saying this needs to be done on a national level. We're not prepared to underwrite, because they're the biggest AAA underpinning the EFSF, CDO, whatever you want to call it, Maryam. But without Germany, there is most of these other ones aren't going to be AAAs by the time the rating agencies are finished. So Germany would want these banks sorted out on a national basis, as Dexia was.
Which
the
France
French,
disagrees
of course,
with.
Don't.
All right, thanks very much indeed. Thanks again for joining us. Robin Marshall, Fixed Income Director at Smith Williamson Investment Management.